Fear is one of the most powerful forces in the financial markets. It can stop traders from entering good opportunities. It can force them out of winning trades too early. It can make them hesitate, doubt themselves, and abandon perfectly sound trading plans. Ironically, fear exists even when traders know exactly what they should do. They have studied the strategy. They have backtested the system. They have identified the setup. Everything is aligned. Yet, when it is time to pull the trigger, something happens. They freeze. The opportunity passes. Then they watch the trade move exactly as expected. The painful truth is that many traders are not losing to the market. They are losing to fear. Today, we're going to explore why fear exists, where it comes from, and how successful traders learn to operate despite it. Because courage in trading is not the absence of fear. It is the ability to act correctly while fear is present. What fear really is. Most traders think fear is the enemy. It isn't. Fear is a survival mechanism. Its job is to protect you from danger. Thousands of years ago, fear helped human beings avoid predators, survive harsh environments, and respond to threats. The problem is that your brain cannot always distinguish between physical danger and financial uncertainty. To your nervous system, risking money can feel like risking survival. When you place a trade, your brain recognizes uncertainty. And uncertainty often triggers fear. Your heart rate increases. Your thoughts become more emotional. Your confidence begins to disappear. The market hasn't done anything yet, but your brain is already preparing for danger. This is why understanding fear is so important. The goal is not to eliminate fear. The goal is to understand it. The fear of losing money. For most traders, fear begins with money, not charts, not strategies. Money. Every trade carries financial risk, and humans naturally dislike losses. In fact, research in behavioral finance shows that people often feel the pain of a loss more intensely than the pleasure of an equivalent gain. Imagine losing $100. Now imagine finding $100. The emotional impact is not equal. The loss feels stronger. This phenomenon influences every trading decision. It causes traders to avoid good setups, exit early, move stop losses, reduce position sizes irrationally, second-guess themselves. The fear of losing money creates defensive behavior, and defensive behavior often prevents traders from executing their edge. The fear of being wrong. Many traders believe they are afraid of losing money. In reality, some are more afraid of being wrong. Every trade is a prediction, and when a prediction fails, it can feel personal, especially for traders who attach their identity to their performance. They begin thinking, if this trade loses, maybe I'm not a good trader. If this setup fails, maybe I don't know what I'm doing. If I lose again, maybe I'll never become profitable. Notice what happened. The trade is no longer just a trade. It becomes a judgment of self-worth. This creates enormous emotional pressure. Professional traders understand something different. They understand that being wrong is part of the business. A losing trade does not mean you are a bad trader. It simply means that this particular outcome did not work. And that's completely normal. How fear creates hesitation. One of the most expensive consequences of fear is hesitation. You see the setup. You know the setup. You planned for the setup, but you hesitate. You wait for more confirmation. Then more confirmation. Then even more confirmation. Eventually, the trade moves without you. Now fear transforms into regret. You watch the market move exactly as anticipated, and the frustration becomes overwhelming. The next time an opportunity appears, you may become overly aggressive because you're trying to avoid missing another move. This creates a cycle. Fear. hesitation, regret, overreaction, loss, fear again. Many traders spend years trapped inside this loop. The fear created by previous losses. Fear rarely exists in isolation. Often it comes from past experiences. Imagine a trader who experiences several losses in a row. The next setup appears. Objectively, nothing has changed. The strategy still works. The setup is still valid. But emotionally, everything feels different. The trader remembers the previous losses. The memory creates anxiety. They start expecting another loss. This expectation influences behavior. They hesitate. They reduce confidence. They abandon rules. The past begins controlling the present. Successful traders understand that every trade is independent. The market does not know what happened on your previous trade, and it certainly does not care. Yet many traders carry emotional baggage from one trade into the next, and that baggage becomes fear. Why professional traders still feel fear? A common misconception is that experienced traders stop feeling fear. They don't. Professional traders experience fear too. The difference is that they understand it. They expect it. They manage it. Instead of reacting emotionally, they rely on process. They trust their preparation. They trust their risk management. They trust their edge. This allows them to execute even when uncertainty exists. And uncertainty always exists. There is no such thing as a risk-free trade. No perfect setup. No guaranteed outcome. The professional trader accepts uncertainty instead of fighting it. How to reduce fear in trading. Let's discuss practical solutions. 1. Reduce risk. Many traders are risking too much. If losing one trade causes emotional distress, your position size may be too large. Smaller risk creates emotional stability. 2. Focus on process. Stop judging yourself based on individual outcomes. Judge yourself based on execution. Did you follow your rules? Did you respect risk? Did you remain disciplined? If yes, the trade was successful regardless of outcome. 3. Think in probabilities. One trade means very little. Your edge reveals itself over many trades. Focus on the long-term sample size. 4. Accept losses. Losses are not mistakes. Losses are business expenses. The sooner you accept this reality, the less power fear will have over you. 5. Build experience. Confidence comes from repetition. The more you execute properly, the more trust you develop in yourself and your system. The courage to trade. Courage is often misunderstood. Many people think courage means feeling fearless. It doesn't. Courage means acting correctly despite fear. The courageous trader is not the trader who never feels anxiety. It is the trader who follows the plan even when uncertainty exists. The trader who accepts risk. The trader who accepts losses. The trader who remains disciplined. Because confidence is not built by avoiding fear. Confidence is built by facing fear repeatedly and discovering that you can handle it. Fear is not a weakness. It is a normal human response to uncertainty. The problem begins when fear controls your decisions, when fear makes you hesitate, when fear causes you to abandon your plan, when fear convinces you that losses should never happen. The traders who succeed are not those who eliminate fear. They are the ones who learn to manage it. Because in trading, fear will always exist. The question is whether it will control you, or whether you will learn to control your response to it. If you enjoyed this video, subscribe to Market Psychology for more insights into trading psychology, discipline, and behavioral finance. In the next video, we'll explore another powerful emotion that affects traders every day. Greed in trading. How the desire for more profits can lead to poor decisions, overtrading, and unnecessary risk. And remember, master your mind. Master the market.